Hi, everybody. KT here. Just wanted to talk about the perfect storm in commercial real estate. All that today and more.
Atocha Global Analytics. Please like and subscribe.
Hello again. Yes, it's a perfect storm. We're going to talk about all that and more today. I wanted to remind everyone that Atocha Global Analytics was created to provide insight and foresight into macroeconomics, real estate and finance trends, and the policies that shape them. Atocha Global Analytics is here to benefit the street level real estate investor. We are not a financial advisor, but we do model investments for key clients. So today we wanted to start with our segment, Everything is Fine. So we keep being told that everything is fine. The Fed has said everything is fine. Janet Yellen says everything is fine. The greatest risk to the economy is the defaults by the U.S. federal government on its debt. Of course, yes, that is a crisis that is easily avoidable. And as if history is a guide, it will be easily avoided again soon. Of course, everybody in government always panics if government is not being funded. They don't care nearly as much if it's affecting the private sector or households or what have you. So anyway, I've got a story here that really addresses something that's going on that is noteworthy, and it's a good leading indicator. It says here, U.S. small business optimism falls to its lowest level in a decade. And of course, with the exception of course, the immediate impact of the shutdowns in 2020, it goes back to 2013. And I'm going to show the chart here. If you go back a little further, there are some challenges, of course, associated with the heart of the Great Recession and the Great Financial Crisis. But in 2013, we were still reeling. We were not truly recovered. It was a very tepid recovery. If you didn't live it, if you lived it, you know what I'm talking about. So anyway, what they cover here in Bloomberg is U.S. small business sentiment falls in April to the lowest level in a decade, reflecting dimmer prospects for the economy and sales that are causing firms to dial back investment plans. The National Federation of Independent Business Optimism Index decreased 1.1 points to 89, the group said on Tuesday. A gauge of owner sentiment about future business conditions slipped to a 4-month low, while a measure of sales expectations was the weakest since August. So yes, it's dropping low. Now, I want to make a note. This is small business. This is not large corporate interests. They operate in a different space. They sense things differently than the small business owner does. And I opine that the small business owner is more attuned to the immediate impact in their area, whereas larger corporations, of course, they can see a much broader picture. They, in some cases, are much more immune because they're more diversified. So anyway, to continue here, that drop in the index that contributed to a pullback in business investment, which of course is usually one of the harbingers of an economic slowdown or a recession. Less than 1 in 5 firms said they're planning capital outlays, such as spending on new equipment and expanded facilities in the next few months, the smallest share since the onset of the pandemic. So that is noteworthy, and it is, again, telling us that there is a recession likely in the very near future. Wanted to move on today to policy matters because policies matter. So today I've got a story here, a gathering world financial sector storm. And again, this sets it up that it is a policy-driven problem that we have right now. So it says here, hope springs eternal in the financial markets. Despite a series of world financial sector crises over the past year, triggered by the world's major central banks' abrupt shift to monetary policy tightening, markets seem to have convinced themselves that First Republic Bank's recent rescue will mark the end of the world financial crisis. This is perhaps yet another case of markets managing to miss the forest for the trees. So it does continue on in that same vein, but it's stating the obvious, the thing that we've been saying, or many people have been saying here about the Fed's recent action. Further down, it says this here: among the more notable casualties of the central bank's newfound monetary policy religion have been around 20 Chinese property developers, including Evergrande. These companies have all defaulted on their debt in the wake of the bursting of the Chinese housing and credit market bubbles. A string of emerging market economies, including Argentina, Ghana, Russia, and Sri Lanka, also have all defaulted, with World Bank warning of many more emerging market debt defaults to come. Meanwhile, last summer, the Bank of England had to bail out the United Kingdom's pension fund to the tune of some 80 billion after these funds suffered large losses on their interest rate derivative positions. Again, it all comes down to interest rates. More recently, at home, we have now had 3 successive failures with Silicon Valley Bank, Signature Bank, and First Republic Bank, sparked by the sudden withdrawal of large uninsured deposits. This occurred as depositors took fright at the large interest rate duration and real commercial property exposure of these U.S. regional banks. Meanwhile, in Europe, we have had the failure of UBS and deep market concerns about Deutsche Bank's financial health. I wanted to read all that. It's a little long, but it's a matter of this is impacting China, large economy. It's impacting the United Kingdom in a significant way, large economy. It's impacted these emerging market economies. So this is becoming a global thing. And then it brought it back to the U.S. and then referenced, of course, more European issues. So it is becoming more broad-based, and it is impacting more economies. Nobody's immune from this. So it goes into a little bit more detail. It says here the combination of overborrowing at previously unusually low interest rates makes the U.S. and world financial system particularly vulnerable at a time when interest rates have been raised at the fastest pace in the past 40 years, and at a time when we could all be on the cusp of an economic recession. This would seem to be all the more so the case when we also have a rolling regional ban and real commercial property crisis, and when U.S. and world financial markets could be shocked by a U.S. debt ceiling showdown this summer. This is what the great conclusion. In 2008, the world's major central banks were caught totally flat-footed by the Lehman bankruptcy and the great economic recession that followed in its wake. With all the clues pointing in the direction of another likely major U.S. and world financial sector crisis, the world's central banks have no excuse for being ill-prepared to deal with such a crisis as they were in 2008. I wanted to highlight that story because it is like the policymakers are driving forward with a blindfold on, using a red-tipped cane when they should be able to clearly see the signs. Everyone sees it, it seems, except for those that are making the decisions on policy. Okay, so as I noted at the start, there is a perfect storm brewing. The perfect storm from higher interest rates and a credit crunch threatens commercial real estate, construction, and jobs. So I wanted to highlight what is one of the unintended consequences of the rate raises and the impact on the banks. The bank failures, of course, one of the things that happens even before any regulation might kick in is they immediately tighten their lending standards. So that's how this article starts off. It says here, tight lending conditions and loans refinanced at higher unsustainable rates could potentially stifle construction and development. And at the end of the first main paragraph is here, it says about 1.5 trillion worth of commercial real estate loans are due to mature over the next 2 years at a steep increase. All right, so that's how the commercial real estate market is impacted and the valuations are impacted, and therefore the loan amounts will have to be lower, meaning that property owners either come up with more equity or they'll have to liquidate the property. So continuing on with the article, it says here, the combination of tightening of lending conditions and loans refinanced at higher unsustainable rates could potentially stifle construction and development in major cities struggling to bounce back from the pandemic. To avoid inflicting more far-reaching economic uncertainty, the Federal Reserve and the Financial Services Regulatory Agency should grant more time to borrowers, including corporate real estate developers, to restructure commercial real estate loans. Consider that the bulk of commercial real estate loans were financed when base rates were near zero, far below today's rates of 5%. No, not only are these rates higher, but the real estate values are much lower, as I just went through, especially in cities afflicted with high vacancy rates from ongoing work from home policies. Prior to the pandemic, 95% of U.S. offices were occupied. Today, that number is closer to 47%. The drop wiped out $453 billion of commercial real estate value, according to the U.S. National Bureau of Economic Research. And of course, that is not fully realized because cap rates are a delayed factor. There are other issues that are delayed as the shifts in demand for office space have decreased so much. Continuing on, it says here more than 70% of municipal taxes come from property taxes. Without a healthy market, that's in this case commercial real estate market or office market, developers will be forced to seek tax abatement, resulting in lower collections for city budgets. So there, again, this has a domino effect, and it's snowballing over the course of years. This is how this will unfold. So it results in lower collections for city budgets and less resources for public schools, law enforcement, public transportation, and other municipal services. A sustained lack of activity in U.S. cities will further diminish the vibrancy of business that rely on foot traffic from offices and residents, ranging from restaurants, retail stores, and more. So any inaction from Washington will cost jobs by creating a downward spiral. That snowball effect they described as a downward spiral. Construction projects are likely to freeze, risking jobs of those in an industry that already experienced the largest ever monthly decline in employment openings over a 2-decade period. So this is spiraling downward, or it's snowballing as it goes. So the article continues further down. It says, this is not a call for a bailout, but for recognition that the monetary and fiscal policy imposed by the federal government during the pandemic created this dilemma. The federal government strongly encouraged workers to stay home during the pandemic, which led to a decrease in demand for office space. Plus, a decade of zero interest rates and cheap money ended with $6.5 trillion of federal spending and 9 consecutive interest rate hikes in a 12-month period. This has been unprecedented, rapid series of events no one could have predicted. Now the federal government must play a role to avoid further damage. And I point out that they are not saying the Federal Reserve, which is monetary policy. They're referencing the federal government, which would be fiscal and regulatory policy. Defaults on commercial real estate loans hit a 14-year high in February. Imagine that. Time will allow borrowers to emerge from the pandemic and work through these challenges so the public doesn't end up bearing the cost. So here's an article that's tied to the previous one. It says here, U.S. markets fear recession, see interest rate cuts ahead as Fed loan survey looms. And at some point when something breaks, when there's a black swan event that really turns things downward, that's when you're going to see the likely cuts. But it says here, some investors see a hard landing for the U.S. economy this year, resulting from the sharply higher interest rates engineered by the Federal Reserve to quell inflation and tighter credit conditions in the wake of regional bank sector stresses. So again, it's the unintended consequences. So this is a comment by Edward Yardeni, who I have a great deal of respect for. It says here, the last 2 rate hikes were nuts, to be blunt. He's the president of Yardeni Research. The Fed could really cause a problem coming and going. He continues further down. He says he did his utmost to convince market participants that the Fed is not going to be lowering interest rates, but will keep them where they are for a while. The market's anticipating a hard landing. However, he's a little bit more sanguine here. He says, but I'm anticipating a soft landing that will allow the Fed to maintain the Fed funds rate at the current level, possibly through the end of the year. The Fed's funds rate is now at 5 to 5.25. And if they stop here, he says, all hope isn't lost. So one of the questions of the article is, will there be an economy-wide recession? The bond market seems to be counting on a recession of at least average magnitude, taking care of the U.S. inflation problem, as yields have slid recently despite Fed raising hikes. So David Bianchi, the Chief Investment Officer for Americas at DWS, notes that in his view, the Fed won't cut rates unless there's a significant, unmistakable recession of greater than average magnitude with rapid deterioration in the labor force. He described an average U.S. recession as having a 2% peak to trough contraction in gross domestic product over about a year. Bianco is expecting a shallow recession to begin sometime in 2023. To me, the most constructive outlook is the Fed not having to do anything for the rest of the year. So switching back to Yardeni, it says here he thinks the U.S. has been in a rolling recession where different industries have been hit at different times by recessionary pressures, as opposed to an economy-wide contraction that many investors are fearing this year. I agree with his statement. He says here, we've kind of been rolling through one without the kind of dire consequences that an economy-wide recession would have. For example, the rolling recession hit the single-family housing market last year as the Fed began raising rates, but multifamily housing remained strong. Then retailers saw a recession after being stuck with inventory following the consumers' buying binge for goods during the pandemic before shifting their spending to services. The labor market remains strong because the service economy has done really well. So again, I agree with that based on my analysis and what he's claiming his analysis shows. I agree that we've been in a rolling recession. I do believe that we had a technical recession in the first half of 2022, even though they changed the definition. I don't know, possibly for political purposes. I don't know what their real motivation might have been, other than the fact that they want to put themselves in the best possible light for any reason. But Yardeni continues here. He says, seeing the Fed having this credibility issue that they're obsessed about after taking too long to raise rates to fight inflation. It was an embarrassment to them that they let the inflation genie out of the bottle without responding faster, he said. So he continues here. He says, now I think they want to be tough, and they're going to do what it takes to bring inflation down. So meanwhile, Fed funds futures and the yield on two-year Treasury note are screaming that interest rates are going to be headed down over the next year. So they expect an event that's going to inspire the Federal Reserve to cut rates. So financial stability concerns are going to be an issue at some point, and there is going to be some sort of tightening in credit conditions and standard. So the conclusion of the story is Powell's plateau. And it says, Yardeni says his estimation of a 40% chance of a hard landing acknowledges he has perceived the Fed could break something in the financial system with its aggressive rate increases. The regional bank failures in mid-March and the start of May seem to be a sign of the Fed having finally broken something, but the central bank continuing to raise rates later that month and again last week to fight inflation. So the Fed, though they've done a pretty good job at containing the issues with the banks, they have broken things, and it hasn't fully been revealed yet. It's going to continue to become more and more problematic because right now we still have loans that haven't had to be refinanced. As it's refinanced, then you see property liquidations when there's insufficient equity. So again, today we've highlighted that it is many of the same challenges. More people are seeing them. It's becoming more newsworthy. And as it becomes more newsworthy, certain things will become clear. One, when the spring selling season for the single-family real estate sector and the problems with the commercial real estate sector have only just begun. It's going to be a significant issue that unfolds over the next year or two, maybe even 3, and then you still have to shake out these problems. So being prepared, recognizing there are opportunities when properties that formerly had been significantly overpriced because of artificially low interest rates going to be priced for reality, or in some cases, if the downturn is severe enough, you might be able to get them at what is an effective discount in the short term, so that in the longer term you benefit from that appreciation. And that is the sweet spot where I am positioned. That's what I am talking to my clients about. And many of my clients are keeping their capital preserved through alternative assets, whether it's precious metals or I think one client, they actually parked a lot of their money in consumer staples, and they said they're just going to sit there and collect dividends for a couple of years to fight inflation, because they know that there are some tremendous opportunities where they're going to be able to buy properties at a discount that are, in some cases, based on the Great Recession. In a lot of cases, these properties were 25-30% discounted over what they should have been when they were sold, and within 2 or 3 years they were up 50% again. So that is what many of my clients are preparing for. And if you choose to prepare, we have an upcoming real estate course that will be very, very beneficial. You will receive an understanding of the real estate market, some of the driving forces behind value, what some of the foundational concerns are for valuation and acquiring a property. You will receive a full underwriting shell, and you'll be prepared to go out and know how to have a conversation with a lender, how to have conversations with realtors or real estate agents or brokers, to have conversations with sellers. If you are not a broker or some other licensed real estate professional, you can have conversations with a lot of different people that you would be limited to under the rules when you are licensed. And lastly, we're going to show you how to go in at the right price, how to reposition to increase value, and then be able to determine the right time to refinance, the right time to sell, the right time to and how to reposition the property. I worked for many years in multifamily acquisitions for a firm that specialized in value add properties. So how you reposition a multifamily property, there are many, many facets to that. Some of that may be included in the basic course and secondary courses that specialize in repositioning. In those, we would cover how you would be able to enhance the value, whether it's through capital improvements or the term we always love, the tenant profile upgrade, which I'm sure you can figure out. So these are just some of the things that are going to be available through that. So with that, I'm going to say thank you and say goodbye for today, and look forward to seeing you tomorrow. Have a good one.
Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. What is happening in the financial world today shows us that those of us on Main Street are in a street fight for our financial futures. In order to win this fight, we need to become truly streetwise.